All right, let's talk Lululemon, the stock. Ticker LULU. I mean, you know the brand, right? You see it everywhere. But today, we're going to peel back the curtain, go beyond the leggings, and really dig into the financials. The big question is, does the company's value actually stack up to its insane popularity? Let's find out.
I mean, seriously, you see that logo everywhere you go, on leggings, bags, walking down the street in any city. It's basically a cultural icon at this point. But for us, as investors, we've got to ask a tough question. We have to look past the hype and ask, what's this company actually worth? What's its fundamental value? And that, right there, is what we're going to unpack today.
Okay, so before we just jump straight into spreadsheets and numbers, we need to set the stage. We got to understand the world Lululemon lives in. What kind of business is this really, and how does that affect its bottom line? Let's take a quick look. So Lululemon is what we call a consumer cyclical company, and it's in the apparel retail industry. Now, why does that matter? Well, cyclical is the key word here. It basically means their sales can go up and down with the overall economy. Think about it. When people are feeling good about their jobs and have some extra cash, they're way more likely to splurge on premium athletic wear. That's the sandbox they're playing in.
All right, enough with the setup. Let's get to the good stuff, the part you've been waiting for, the numbers. We're going to kick things off with the high-level financial health check, just to see what we're really dealing with here.
First up, market cap. We're looking at nearly $20 billion. For anyone who's not sure, that's the total value of all its shares on the stock market. And what that number tells you right off the bat is that Lululemon is a huge player, a real heavyweight in the industry.
And a company doesn't get to be that big without some serious sales to back it up. They've pulled in almost $11 billion in total revenue. That's the top line number, right? The total amount of money they brought in before we even start talking about expenses.
Okay, let's dig a little deeper with these metrics. The trailing PE is about 11.4. That's basically the price tag investors are putting on $1 of Lululemon's profits. But look at this gross margin, almost 60%. Let that sink in. For every dollar of stuff they sell, they keep 59 cents to cover other costs and, hopefully make a profit. For a retailer, that is just wow. It screams premium brand. And then there's the return on equity, or ROE, over 42%. That's a huge number, and it tells us they are incredibly efficient at making money with the cash their shareholders have invested.
So those dashboard numbers are great for a quick snapshot. But now it's time to pop the hood and look at the engine. We're diving into the actual financial statements to see how all this is possible. This, my friends, is where you find the real story.
First up, the income statement. And man, you don't need to be an accountant to see the trend here. Just look at the total revenue. It's a beautiful, steady climb from $8.1 billion up to over $10.5 billion. But here's the kicker. Look at the bottom line, net income. It's more than doubled in that same time. So this isn't just a story about selling more stuff. It's about getting much more profitable while doing it.
Next, let's glance at the balance sheet. This is a really simple but powerful way to check a company's health. On one side, you've got total assets, everything they own, at $7.6 billion. On the other, total liabilities, everything they owe, at just $3.28 billion. So what they own is worth more than double what they owe. That right there is a fantastic sign of financial strength.
And that brings us to cash flow. Honestly, you hear it all the time, but it's true. Cash is king. This might be the most important piece of the puzzle. Lululemon generated over $1.9 billion in cash just from its day-to-day business. After they paid for things to maintain and grow the company, they were still left with $1.17 billion in what we call free cash flow. That's pure cash they can use for whatever they want, new projects, paying off debt, you name it.
Okay, so let's recap. Lululemon is a financial powerhouse. Strong growth, super profitable, tons of cash. But that leads us to the billion-dollar question, or, well, the $20 billion question. What should the stock actually be worth? To try and answer that, we're going to roll up our sleeves and use a classic valuation tool, the discounted cash flow model, or DCF for short.
Now, I know discounted cash flow sounds complicated, but trust me, the idea behind it is actually pretty simple. It all boils down to this. A company is worth the cash it's going to make in the future. The DCF model just helps us guess what those future cash flows will be, and then it, discounts them back to figure out what they're worth to us right here, today. It's all about finding that intrinsic value.
Now, anytime you try to predict the future, you have to make some educated guesses, right? Some key assumptions. For our base case model, we're plugging in a discount rate, the WACC, of 8.6%. That's kind of our risk-adjusted interest rate for this whole calculation. We've got a beta of 1.07, which means the stock is just a tiny bit more jumpy than the market as a whole, and we're penciling in a revenue growth of 7% for a while before it cools down to a more sustainable 2.5% forever. These are the ingredients for our valuation recipe.
Because those assumptions are so important, we never just want to look at one outcome. It's smart to look at a range. So, if things go sour, our worst case, we're looking at a value around $173. If everything goes perfectly, the best case, it could be worth over $300. But for our main analysis, we're going to stick with our most realistic base case. So, drumroll please. After we crunch all the numbers with our base case assumptions, the model spits out an intrinsic value of $212.18 per share. So, based on all that cash flow we talked about, this is what our analysis says one share of Lululemon should be worth right now.
All right, this is the moment of truth. We have our number, our calculated value. Now we have to compare it to the real world. What is the stock actually selling for on the market today? Let's put them side by side. And there you have it. Our model is telling us the intrinsic value is around $212, but the market is pricing it at about $167. That's not a small difference. That is a pretty significant gap between what our model thinks it's worth and what you can buy it for today.
So, what's the takeaway from our model? It's pretty direct. Based on this discounted cash flow analysis, the stock looks, well, undervalued. Simple as that.
But hold on a second. This is a really big but. Our model is just one tool, right? It's not the only opinion that matters. We have to look at what the pros on Wall Street are saying, and lately, they've been getting a little nervous. You've got firms like Needham and Baird downgrading the stock to basically a hold. And Jefferies is even more bearish, sticking with an underperform rating. This adds a whole other layer to the story, doesn't it?
And that leaves us right here with the ultimate question. On one hand, our deep dive fundamental analysis suggests the stock is a bargain. It's undervalued. But on the other hand, the market sentiment, these analyst downgrades, they suggest there could be trouble ahead, risks that our model isn't seeing. So which is it? Is this a fantastic company on sale, or is it a warning sign that Mr. Market knows something we don't? And that's the multi-billion-dollar question every single investor has to answer for themselves.